Thanks for following us, and this is our sixth podcast. We will continue our discussion on inflation, recession, government policy, and investment strategies.
There have been a lot of updates on inflation and economic data over the last few weeks.
Yeah, there are a few CPI data, consumer confidence index, and job data released over the last several weeks. David, what are the major updates and big surprises coming out of the October CPI?
October's CPI was a game changer. The October core CPI, released on November 10th, came in at a soft plus 0.27%, below street consensus of plus 0.5%, and breaking trend from the plus 0.6% seen in August and September's CPI. The S&P 500 rose by 5.5%, an eye-popping rally, and so the soft CPI had a seismic impact. It is likely to continue to support greater magnitude than the massive bearish reaction to August CPI, when stocks were down by 15%.
Is the cooling CPI repeatable in the next few months? Many macro analysts skeptically suggested this soft reading is not repeatable.
There are three main drivers for the lowering CPI. There are shelter, durable goods, and medical health insurance. We believe these three drivers are repeatable. Shelter, which is rental cost and housing price, finally showed a meaningful slowing in CPI month over month. In addition, durable goods finally showed bullish payback as durable CPI fell to negative 0.7% month over month. Another important price index is the medical health insurance, which massively flipped to negative 4% month over month from the 12 consecutive months of plus 2.4% since October of 2021. In other words, there are building drivers to massively slow CPI core inflation over the few months. It is possible we will see 3 to 4 consecutive months of plus 0.3% core CPI month over month.
Good point, David. This would pull down core inflation towards 3.5% or so, far slower than the 6.5% seen in most of 2022. I also saw some key inflationary product price coming down. David, have you seen the gas price drop recently?
Gas prices dropped over 15%. The house price also declines. There are more house listings in the market, and it seems that the Fed's interest rate hike pushes the mortgage rate higher, and less people are buying houses now.
We will probably see house prices continue declining over the next few quarters as big companies started layoffs, and we will probably see less buyers in the market. Also, I noticed used car prices also dropped quickly. David, do you remember when people had to pay 30% higher for used cars during the pandemic?
Yes, used car price drop also helped the CPI data in October. I think as supply chain eases, more durable goods will drop farther. Recently, big retailers like Walmart, Target, and Best Buy are offering big discounts for home furniture, TV, and etc.
That definitely helps. It is also interesting to see the ocean freight costs drop dramatically over the last 2 months. The Baltic Dry Index, a major indicator of bulk shipping rates, settled at 1,149 points on Tuesday, lower than over 5,000 points during the pandemic. This would help reduce many product costs, as most of the export and import products use ocean shipping.
Good point. It seems that the concerns over the economy slowing down will financially affect these energy and shipping costs. According to the University of Michigan's survey of consumers, consumer sentiment fell in November despite rising interest rates and higher long-term inflation predictions. Along with the ongoing impact of inflation, consumer attitudes have also been weighed down by rising borrowing costs, declining asset values, and weakening labor market expectations.
I saw the consumer sentiment index this month fall from 59.9 to 56.8 in October. Clearly, there is a ripple effect of inflation. I think the Fed's policy is working. Let us talk about the Fed's minutes in our next podcast, for I think it's very important to understand the Fed's view on inflation and the overall economy.
That is right. Thanks for watching. Please follow us if you are interested in listening to our thoughts on economic and financial events.